you get a cleaner idea about what the market is gonna do next. So always keep this futures chart open. It will tell you a lot more about what you are doing. About price action and volume action. So what we are focused on is volume action, right? There are about three elements, okay, which go into the makings of a chart. Price, the most important one. Supporting one is volume, and the second supporting one is time. Okay, and at different replays, different days, different times of the session, and at different days of the week, each of these three play differently, right? So you know that between 2:30 and 3:30, because of the option plays and because of settlement pressure, because of this particular time, 2:30 to 3:30, the market works differently, right? And that point of time, the time becomes more important than price and even sometimes volume. But at certain times, let's say about 9:15 to 10:15, the volume component of the market is more important. A lot of traders are brought up into thinking that price is everything, and that concept is still there. Bhav Bhagwan Che, But Bhav is not the only Bhagwan. Bhav is not the only Bhagwan. There are three Bhagwans. One is price, one is volume, and the third one is time. And if you can pay attention to these three, especially as a derivative trader, you will cut out a lot of mistakes, okay, which you make in derivative trading. The whole idea as retail traders is to right? So all of you have seen, okay, this data from an options table before. Now the point over here is how do we, okay, maximize, okay, this information which is coming to us, okay, from the options table. Now the thing is about this particular information, okay, which you are looking at on your screens right now, okay, especially, okay, this options, all the strikes and all the LTPs and all the volumes and all the open interest and all, this is flowing data. This data, okay, keeps coming in as the day progresses, and you tend to get a lot more information as the day goes on, as the day wears on. Now, what do we do, okay, with this information? How do we maximize this, and how do we actually, okay, use it to make profits today? That is what it's the agenda of today's talk is going to be all about, right? I'll keep the floor open for questions. Whatever questions, okay, you have, you can, okay, ask them directly, okay, to me. I'll be reading you all also. But we'll basically, okay, be focused on the role of information in the options market today, right? Now, I'm sure, okay, all of you have traded on the National Stock Exchange and have traded, okay, multiple days and are not new traders. I know a lot of you, okay, have been with us, okay, for a long time, and I know, okay, about the work we do. But for those, okay, who do not know me or do not know, okay, about the work, okay, which we are doing at VTrender, a quick introduction is in order. My name is Shai, and I run an organization by the name of VTrender. And besides, okay, being a derivative trader for about 18 years now, I basically, okay, found it in me mission, okay, to go out and spread, okay, what I know to fellow derivatives traders. And to do this, we've started working with people on the trades and the strategies which we use, the charts which we look at, and all the information which I look at during my trading day is now transparently visible to anybody who wants to look at them. Because of the limitations imposed on us by the regulators in terms of data, there is a ban on providing live streaming data on a free plan, but we do have a free plan for traders who are new to markets, whereas the premium plans would have live streaming data enabled, allowing you to meet those regulations which are imposed on by the exchanges, and you have an option to go in for those things. So today, the data I'm going to share with you in the options table is going to be part of the premium plan. And if you do not see this, this is what you would get in a full-fledged plan. And I'm going to lead the conversation today purely on this information which is there in the options table, right? So I'm going to walk you through what I look at, what to make out of this information, and how best to utilize this information to form good trading decisions through the day. As I speak to you, most of the questions which you may have about what I intend to speak could get clarified, but in case they do not, the chat box is open. You can feel free to ask any number of questions over there, and I'm here to answer these questions for you. Right. Now, first and foremost, when you're looking at this table, there is a lot of variation of these tables outside. We believe in providing this particular model of the options table to all our traders, and just want to explain to you a bit about what the information in this table is all about. Right. So the central figure is this column right here, which is the strike price. So we start from this central figure. Always on our option tables, look out for this number, and if you go left, you will see the calls, and if you go right, you would see the puts. So we begin with here, and if you look at around over here, you will see some numbers which are S, some numbers which are N, and some numbers which are in B on green. That simply is this particular strike is controlled by sellers. This N would mean that this is neutral, and this particular B would tell you that those strikes are buyer dominated. That means buyers are there, so either the put side or the call side, but majorly dominated by buyers. That's why you would get a B over here. I'll also show you later in the program on how to pick up these charts, but we start from here and we go left, and you will see immediately the column right next to the left is the price. You'll get the call price and the put price right next to each other. And this is a moving price through the day, LTP, and 95% of us are always price based traders, and this is a number which is very dear to us because this determines our entry, and where it goes during the day also decides how much profit we are going to take, or whether we have to pull out of a position in a stop also. Right now, the column right next to the price is the most important metric. In fact, one of the two most important metrics of the chart, and we call it the VPOC and the VWAP of the particular call or put which you are looking at. So if you're looking at this particular section on the left, this VPOC and VPOC would be of these calls. So if you're looking at this 24,300, then that VPOC is 1.2 right now, and the VWAP is about 22. This is of course of today's trading day. And if you go on the right, the VPOC and the VWAP is 1.3 of today, or the 24,300 put, and 9.84 is the VWAP. Now VWAP, volume weighted average price. I'm sure all of you are very, very familiar with it, and it needs no introduction. All of us know how to trade with the VWAP, and simply means in terms of an options market, if price is above the VWAP, that means that instrument or that call, that put is in control of buyers over there, and if price is below the VWAP of that instrument, then okay, writers or sellers are in control at that particular strike. That's the important okay formula, so to speak, okay, when you hear okay this word called VWAP, especially okay for an options market, right? And just a clarification over here, whatever we're going to be discussing is going to be central okay to the options market today, and we're going to be talking about specific use cases of the options market, right? So if VWAP is volume weighted average price, what is VPOC? Now VPOC is simply the volume point of control, or in short, the area where the largest concentration of volume is on a volume profile chart. So there is a distinction we make at VTrender when it comes to volume. 95% of traders, when they look at volume, they look at volume below the price bar. Okay, at VTrender, what we do is we focus on volume right next to the price bar, and we also focus on volume inside the price bar. So volume inside the price bar is called order flow. Volume next to the price bar is called volume profile, and volume below the price is the traditional acceptance of that word called volume. It was always okay meant to be volume below the bar, right? Now there is a reason okay we've added a volume column right next to the VWAP and the VPOC, because okay this is the flow of transaction money, the transactions during the day, right? A lot of people will not look at this as a factor, and I will be the first one to admit to you that for the options market, there is a more powerful metric, which is the open interest, which is the substitute, or you can say a surrogate of volume, which helps you okay to decide okay what kind of money is coming into that instrument. We'll talk about that open interest also, but purely over here, if you look at the volume, okay, you will tell you which particular strikes of the market are attracting maximum volume, or which are attracting money that particular settlement day. So if you go down, you will see okay that some of these rows within this column of volume are marked in orange. Now simply put, this means okay that this particular strike had the higher of all the volume okay which got transacted. So every time okay you see this font in orange, that means okay there is a lot more volume coming in, and this is okay the metric okay which I look at when I am looking at which strikes are gonna do what in the market. So you will see that a lot of this ATM and in the money and slightly okay OTM is gonna always have the higher of the transactional volume. Now what does that mean? It means that you get a maximum number of traders trading at the money, okay, when compared to out of the money, right? So something like a 23,900, though popular, okay, and though used, is not having that kind of volume, whereas compared okay to at the money 24,300, right? So always okay pay attention to where the volume is. We also look at IVs, and these IVs are now okay inflated because of the settlement okay which happened about 1 hour back at 3:30, but these would be in the region of about 13 to 15 to 17, okay, during the day. They are steady on most settlement weeks of the year, but about a month back, the IVs were in the range of about 25 to 30 to 35. What does that tell you? That tells you that an IV which is higher will tell you okay that there is a lot more expected volatility in that particular call or that put. All right. So if you are the kind of trader okay who's say used to about 20-point stop loss, or most of us okay in writers okay use a 30% stop loss of strike and all, don't make it general, okay? Always okay make it in the context of the IV. And if an IV is there around 13, 15, 16, yeah, you can use your 20-point stop loss. You can use that 30% of the premium as your stop loss, etc. But if this IV is double, okay, instead of 13, 15, it's about 25, 26, that 20-point stop loss is not going to work for you. right? And that 30%, okay, which you have in premium, which most of us, okay, use as a stop loss, it's not gonna work for you. You will end up, okay, cursing the market, okay, because the market is gonna just keep chopping you out, in and out, only because, okay, you have not paid attention to what the IV chart is telling you, the IV data is telling you, right? So this metric, okay, we have it always on our charts, and through the day, if this volatility changes, if it was 10, 12, and it suddenly, okay, shoots up to about 16, 17, you've got to be careful, because the market is expecting a lot more volatility coming your way, right? And now the column, okay, right next to it is what we call the DOI and the OI. And I'm sure, okay, all of you are experts, okay, in this right now. This is, okay, what is driving, okay, the information at the National Stock Exchange. DOI is simply developing OI, which means the open interest, which started at 9:15 and develops through the day till 3:30. And OI is all the OI, okay, which is accumulated in that call or in that put from the start of that weekly series, right? Now, all this data I'm looking at is for a duration of one weekly series, and this one, okay, I'm looking at is the 4th of July right here, right? So this is the particular one, okay, data of this, and all this open interest, etc., is for this. So if you want to, okay, go into the next one, the 11th of July, you just simply click over there, and the data, okay, which will load up on your screen, okay, on the options table, okay, would be for the 11th of July. If you want to see, okay, what the bank Nifty is doing, the DOI, etc., is gonna be changing, okay, based on the series, okay, which you choose. So one click over here, okay, to get through to all the open interest, etc. Another point, if you're seeing, okay, that you're traditionally, okay, used to seeing a lot of numbers, okay, for large numbers for open interest, but if you look at my chart, you're seeing a very small amount, okay, mentioned over here as the open interest. That's because my settings are in terms of contracts. They are not in terms of the total volume of the market or total shares of the market. How do I change that? Right next to the table titles, we have a gear icon over here, which is this one. And if I click on this, I get to go into settings, right? And I have chosen contracts. If you're not very familiar, okay, with the contracts, OI and volume data, I have chosen contracts because I like, okay, all the data across all my Nifty, Bank Nifty, Fin Nifty, and all the rest of the mid cap Nifty and all that I do to be uniform, okay, from Monday to Friday. So which is why, okay, I prefer, okay, looking at it everything in terms of contracts, because relatively speaking, it tells me, the Nifty today, okay, at one particular strike, okay, had about 20 lakh contracts. Now that, okay, is a little bit more better way of for me, okay, to measure the kind of volume coming in when compared to, say, a Bank Nifty of yesterday or a Fin Nifty of day before. And if you're not using it, I highly encourage, okay, that you start reading data in terms of contracts, because it will give you a better relative picture about what is expected in the market, right? So all our data, including the volume and including the open interest, is now depicted in terms of number of contracts, right? And to the extreme left, the first column, in fact, there's a lot of powerful information over here, and this is market moving information over here. So there are basically, okay, about 3 columns in this 3 sub columns, okay, within this particular column. We have price, the max OI, and the time of the max OI. And same thing, okay, the price, the min OI, and the time of that min OI. Now, how do I, what do I do, okay, with this information? So what I do over here is I look at that max OI. So in this particular strike, 24,300, the max OI hit was about 13,19,018 contracts at about 308. This is not really actionable. It's come down to about 7,34,000 because, okay, some profit booking, okay, happened later and they withdrew, okay, some of that money. But the min OI was reached at 10 in the morning to about 272. And I always see this max OI and min OI against, okay, the current OI, and this one in green, which is the DOI. The DOI is the amount of new money which is flowing into the instrument today. It's the amount of new money which is flowing into the instrument today, right? And that is gonna tell you the kind of liquidity which is there and the kind of movement which is there. The more the amount of contracts flowing into a particular strike or into a particular instrument, a call or a put, the bigger, okay, can be the movement if price goes against them, right? So generally speaking, if this keeps on rising higher, the DOI and the open interest keeps rising, okay, that's a market, okay, which is attracting new money and they are stable. But if this starts to drop off, and I see a factor over here, okay, where the max OI is hit and we are well below the max OI, then I start thinking, okay, why are these writers covering? And if they are covering, price is gonna be, they are covering for a reason and price is suddenly gonna move against them. So use this as a factor to see where the highest point in time was. We tell you the price at which it was high, we tell you the time at it was high, and we also tell you, okay, what was the amount, okay, at the highest point. And that's a kind of a peak where you can look at and you can quickly analyze, okay, how far, okay, we have come from the peak or from the bottom valley of the market, and from what time to what time. So suppose it's at 12:30 and I saw, okay, that the low was here and the market is still building up open interest. That means money is flowing into this particular call and they are stable to keep things over here, right? So this price, max OI and time, extremely useful. You will find this, okay, in this particular section also, price, max OI time and min OI time. All right, and the same information is replicated up to here for both calls and for puts. Okay, and I'll talk to you, okay, about these remaining columns in a bit. But before that, okay, let's look at some of the questions, okay, which have come in. And if you have any questions, okay, to ask me, okay, about what we've discussed, feel free, okay, to ask them in the text chat. Okay, so the question is, okay, how to read OI and use it for deciding bias. OI by itself, okay, cannot decide bias. So if you believe that and somebody's, okay, told you, okay, that that is the only way, okay, you can decide a bias, I don't agree to it. Different people, different opinions. My personal opinion is I use OI with a number of other factors, which all of you know, okay, I use my OI along with market profile and my order flow as a supporting tool. Okay, so if you feel that you can make a decision purely on open interest data, it's a little bit off the truth, because those people who created that open interest, the early movers and all, early movers and shakers, they created it off a chart, right? The earliest people who created the open interest, okay, see, the way open interest works is some people come, create the open interest, establish positions, open interest builds up. Some other people come behind them, look at that open interest and build further open interest. And a third set of people, okay, which comes in, okay, looks at the open interest which is built up and then, okay, create further open interest. Okay, if the market goes against them, the third set of people are the ones, okay, which end up losing money, because their basis is a second group of people. But the people, okay, who formed that open interest or took that position and built that open interest based on a chart and based on a reading of the market, they have a grounding and they have a reason and they have a valid strategy on the basis of which, okay, they have built that open interest, right? So don't just use open interest. You have to, okay, get good at understanding technicalities of the market. I'll show you a way, okay, I build up, okay, my bias about the market, and that's, okay, through market profile and order flow. Use open interest as a supporting tool. So the question is, so what we do is there is no volume definitely, okay, on the spot chart, okay, but we basically found a way of appending data to a spot chart, okay, from a futures. So that's an internal, okay, thing, okay, which works out, and the volume point of control, okay, can be added, okay, to spot charts also. The most perfect way is always going to be on a future, but because, okay, we are so much used, okay, to working with a spot chart, we found a way of adding the futures data on directly, okay, to a spot chart. So if you want more information about how to best use the VWAP and the VPOC, the recommended thing is that you use a futures chart. But if you're looking at it from a spot point of view, it's not that it cannot be done. There are always ways and means. Okay, and if you are wanting to really search for them, you will find them out. Okay, we wanted it, so we found a way to do it, and we are quite happy with the way it works out. Right, so that's it for now. So for the max OI, and I want to continue because there's a lot I want to cover as we move on. So on the right side, I'll just shift my chart a bit, and I just want to explain a few more columns. So we have something called C and an PEOI spikes. Now these also work on the same principle as that max OI time and all, and they'll tell you at what price and at what time that particular CE spiked. And whenever you see a spike happening around the same time, that tells you that there is a movement happening in that strike. This we can discuss in detail because there's a little bit more detail required, but just to put it in a very short statement and to come across to you about what is the intention of adding this column is it is to capture OI spikes, and we capture fast rapid movements whenever they happen, and they will be seen on a chart as well, which I will be showing you in a bit. But they all come in here as a column, and sometimes you will see that the market suddenly goes against call writers or put writers, and then the market is suddenly showing us a lot of spikes happening across all the strikes. So when this happens, it shows up in this particular column over here, right? We track straddles right over here in these two boxes. We can pick up any chart and open up a straddle, and I'll show you how to do that. The straddle price is reflected over here, the straddle VPOC and VWAP. So you don't have to go very far to find out what price the straddle VWAP is or the VPOC is. Both are right here. So 88 for the 24 250, 36 853, and generally when the LTP of that straddle is below this, you can say that the straddle is safely with the writers, and if the price is above, that's the time you can expect some kind of a straddle covering coming in. The net of all the open interest is here, the pain is here, and the synthetic future 24,300 is where the pricing would eventually come down to. This is simply a math which is strike plus CE minus PE. And even if you do not want to have a look at this column, even in your terminals, always look at that strike and you do CE minus PE, and you use that strike, you will get the synthetic future or the synthetic price. Now this is what decides the final pricing. Quickly walk you to the top of the table, and then we will look at more actionable info to drive. For now I'm still walking you through what is the information available, and then we'll take it one step down, and I'll walk you through how best you can utilize this information. At the top over here, you will see that there is something called gamma 0, which is the point at which the gamma is highest in the market. The OI pain is the same metric, put differently, different calculation. The range expected by gamma, the series wicks, the wicks range, and this thing. So there is a PCR, volume PCR, etc. All this is there to tell you at the start of a day about what is the kind of range. So I always look at this range, and I look at this gamma wall range, and I try to find out how much the market is expected to move for that particular day. Now this is with a certain degree of probability and possibility. Cannot say it's 100%, but within that realm of possibility, we try to find out how much the market can move, and whether you can write puts below this number or calls above the higher number is subjective, is something which you can do that. And right at the very top, you get all the instruments you look at. And what I generally tend to look at is this closing price. This is in the last 30 minutes. This will tell you where the strike is closing, where the market is closing on a settlement day. The synthetic future is also right next to it, the time, etc. The ATR keeps us honest and humble, okay, about what is the kind of movement to be expected. So I do not expect, okay, a 300-point Nifty move if my ATR is 5 and 5-day ATR and 14-day ATR is 190. It's kind of stupid, okay, to expect a 400-point range, right? So just play, okay, to the pitch, play to the environment, play, okay, to what the market is telling you to do, and then, okay, you decipher accordingly. Now I'll just run through what the options table is all about. And the reason, okay, I wanted to run through this information with you is that because, okay, at the start of a trading day or at the end of a settlement day, I do my work, okay, at about 8 p.m. in the evening, just before, okay, the start of the new session when the trading session is closed. And I do a lot of work if the previous day, if the next day is a settlement day. And this is what I called my pitch report. For those of you who are familiar with cricket, this is, okay, what is called the pitch report. And why is this called a pitch report? Because this report, okay, tells me, okay, how much runs are to be scored on that pitch. Now every single pitch is different, every single settlement day is different, but one look at the open interest data, one look at the volume data, and one look at the charts, okay, within this data should tell you, okay, with reasonable consistency, how much runs are there in the pitch. Now all pitches are different, like I said. So some pitches, okay, will just give you, about 100 runs. Some pitches, okay, are good, okay, for 250 runs, okay, are also not going to be enough. So some days are going to be trending and some days are going to be flat. Today, okay, was an example of a flat day, and there was, okay, a little bit of evidence in data that it could be a flat day today, right? So all this pitch report, okay, comes to us, okay, as we go about. Right now, what do we do? Okay, first thing, what we do is we look at where the open interest is concentrated, and obviously, okay, it's going to be concentrated at the money, right? Now when it is concentrated over there, okay, you can pull up a chart of that strike via this button over here. So if you just press this button, there are two buttons over here, right at the central column, the strike. If I press this, I'll open up, okay, the entire straddle in a market profile chart. Now I put this thing out yesterday. I did not trade this today because there was another element at trade, and this raid, okay, and this trade had become risky. But I put this out on Twitter today, or Twitter yesterday, and I was looking at this straddle. So this is how, okay, you pick up a straddle straight, okay, off the options table, and the information, okay, comes to you, okay, from a market profile chart. And what is the market profile chart? Market profile chart for an option is simply, okay, giving you, okay, three important points. Where is the VWAP? And all our VWAP is going to be in green. Okay, where is the POC? The POC column, which I pointed out to you, the VWAP and the VPOC, that is this pink line. So the VPOC was 231. Here in this case, okay, the VPOC, okay, was right here. It was around this 160 number. And the third thing it gives you is this shaded region. This shaded region, which is called the value area. Now these are the only three metrics, okay, you actually require. There's actually one more required, the fourth metric, okay, which is the profile shape and the profile structure. Now this is many times important to us as traders. So yesterday, okay, I called this profile a 313 profile. And whenever, okay, you see a 313 profile, you just focus, okay, on the value area low and the value area high. And if the market is below the value area low, if the market is below the value area low, okay, guess who is in control? The sellers are in control, right? And this is a good environment, okay, to be a writer. As we saw today, this market, okay, never made it above value area high, and the market, okay, kept dropping all the way zero. But this particular shape, this particular value area, and this particular structure was conducive, okay, to this kind of a trade today. And this was one of the things, okay, which came out, okay, in that pitch report today. Okay, was it a very good low risk, high reward kind of a trade today to take? Not at the open. Okay, the market, okay, was very volatile in the very first hour of trade, and I didn't recommend this trade, okay, to a lot of us in our trading community also. And I personally, okay, did not take this trade. The reason being, okay, that there was a lot of buying which came in alternatively in both, okay, the 24,200 call today and the 24,400 put also later on in the day, right? So so this is, okay, the strike. Okay, you can get this directly, okay, off the options table. From the options table, if you click, okay, on this right here, these two columns, you can also, okay, get, okay, what all of you are familiar with, I'm sure, and this is what we call a line chart. Right here, this is the straddle, and at one click, okay, you can get this line chart also, right? Now what basically, okay, you get in this line chart is, okay, so this is the entire, okay, line chart, okay, which is here, okay, the price, okay, sloping down, and we've added, okay, this particular element over here which tells you, okay, how much, okay, this open interest is adding. Every time it is in green, it will tell you that there is a lot of open interest coming in, and it starts, okay, pulling down like this in pink color. This is, okay, telling you, okay, that the open interest, okay, is coming off the instrument, or money is, okay, coming away from this particular instrument. Okay, to this chart we've added VWAP, which I've been saying, okay, is a green colored line, okay, flowing down. And to this chart, I've also added the volume point of control, which is the zone where the maximum volume got traded, right? Now, okay, I'm looking at all this open interest coming in, and let me also add the open interest, which is this blue line, right? Now, in this particular straddle, I'm seeing this green. Green means, okay, open interest is coming into the instrument. Okay, I'm looking at where this came in, and I'm looking at this VPOC as it is forming, and wherever, okay, this VPOC is, that is telling you, okay, that the maximum open interest came at that level, right? This continues green right up to here. So in open interest, okay, came initially at 120 here, then it came at this 80, then it came at 60, then it came at 40. Now, thankfully for this strike today, most of the time, okay, it stayed above VWAP. Most of the time it stayed above VWAP. Most of the time it stayed below VWAP. Sorry, I'm very, very sorry, okay, about that. Most of the time it stayed below VWAP. This was the only time it went above VWAP, and there was a slight dip as it happened. Okay, all you need to do in a straddle chart, and this is basics, that you have to watch, okay, if the straddle, okay, stays below the VWAP. Okay, but more importantly, okay, what you have to do is you have to also watch, okay, the zones where that volume was traded, and for that, for us, okay, that information is given to us by the VPOC line, right? And guess what happens, okay, if price, okay, crosses the VPOC along with the VWAP, all these people who came in here and built all this open interest, now they are in trouble. Now they are in trouble, and this is the time, okay, you can pick up a short or a long gamma trade in the market, right? So this is the way, okay, you can work out with these particular instruments, right? I'll quickly pause, okay, and I'll take, okay, some more questions also. I think, okay, there are no audio issues. Audio issues are fine. So gamma wall updation is end of day on live. There's no purpose of gamma wall updated end of day. Gamma is real-time live streaming information, and the best value to us, okay, is when it is live. So gamma wall is updated live as the market moves every second. All the analyzing, okay, which is required is already here. There's nothing, okay, an Excel, okay, can do. It's already analyzed and put up in this table, so there's no need, okay, of putting it into is the line chart available for stocks? So some of the more liquid ones, okay, have them, but we'll be having, okay, a lot more, okay, for stocks coming in. Currently, okay, we are focused, okay, on how it is working in the options market for the indices, and that's, okay, how we are going to be looking at it. Right now, if you want to look up and find out, okay, what to do, okay, with this particular strike, say only one side of it, say a call, okay, so you can pick up, okay, the market profile chart of this call, and this was a little bit volatile today, but it dipped, okay, below value area low, and it was completely in control of the writers, right? Now again, okay, what I'm emphasizing over here is that the open interest itself is not enough, okay, to tell you, okay, which way the bias needs to be taken. You have to, okay, have a market profile chart open, and the reason the market profile chart works better than other charts is because, okay, it's got an element of time and volume, and this is just not my evidence or my observation. This is actually the observation, okay, from a large group of people, okay, I trade with every single day, and they have got, okay, some fantastic results, okay, about taking, okay, information from the markets via a market profile chart and utilizing it, okay, to create, okay, the open interest, okay, which is seen in the market. So it's their evidence, okay, which comes in. The other way, okay, you can do it is you can go, okay, through this menu over here and look at the open interest built up via the order flow also, right? So right at the open, this is the order flow of the 24,300 today. So, you know, right at the open, okay, there was a case, okay, to be long, and these writers, okay, were under pressure, but there was a little bit of covering, okay, which happened over here, 110. But since these sellers, okay, showed up, since, okay, these sellers, okay, started showing up over here, this was, okay, a classic way of this market, okay, showing that there was a lot of writing which happened in. So all through this, the COT, okay, which is the commitment of trade, stayed red, and when a COT, okay, is red, it tells you, okay, that there is a lot of writing, okay, which is coming into that instrument, and you'll see, okay, all of this writing, okay, came here. So if you want to find out, okay, what is the bias of the market, the most accurate way for you, or the most proper way, okay, for you to do it, is to look at it in terms of an open interest chart, search for these imbalances. You will have to be a little bit more structured in your understanding of the order flow, and there is a little bit of work involved in understanding the order flow metric, okay? But if you can do that, okay, then, okay, understanding the bias of the market, it becomes relatively easier for you. So these writers came here around 70, 75. They sold into this market. This COT, okay, went green and went red, showing, okay, that there were writers, and they continued, okay, till there was a little bit of covering over here, but they continued, okay, writing right up to the close, okay, in this. And if you want to do it, okay, the other way, you can look at the puts also simultaneously. This is the 24,400 PE, and there was, okay, a case over here, okay, where the market, okay, suddenly, okay, found a lot of buying. This is, okay, what we were tracking early. 70,000 lot odd buyer had come in, who took it up in the market, and that is why, okay, there was pressure, okay, put in on that 24,350 PE during the day. What we recommend is, on a settlement day, is either, okay, to keep a call or a put out of the money, in the money, open on an order flow chart like this. You can keep it on a 30-minute time frame and keep tracking, okay, the open interest across, and look for where these imbalances are coming in. This is a very handy way, okay, for you, okay, to look at where the information or where the market is adding the open interest today, right? So this is, okay, what happened earlier today, 24,350. So all this buying, okay, which came in, was the reason, okay, that this instrument, okay, suddenly, okay, shot up, and that put, okay, a little bit of pressure. But otherwise, okay, apart from that, the market, okay, was very, very stable, okay, throughout the day. So just, okay, on that particular strike, staying, okay, with it. So what we noticed was that this was a very stable environment, okay, for writers today, in that 24,300. But here, right at the open, in that very first hour, there was a run done on pull writers, but before that there was a run, okay, on call writers. But after that, there was a stable open interest added throughout the day, right? And you could see that in the options table also. You could see that in the options table also, and the open interest, okay, right through, okay, was going up higher in the 24,300 CE. So the question is how to choose the strike price, okay, for your analysis. So it depends, okay. If you're a writer, you will choose and add the money. But if you're a buyer, I always, okay, suggest, okay, that you go in the money. So you go in the money by about 100. So if the movement of price is around 24,300, and if you're looking, okay, for a downward move and the order flow is signaling a move down, you'll go with a 24,400 put. But stay, okay, within these orange ones. Go for the most liquid of those strikes and choose your strikes accordingly. Right, I'll pause here. If there are any more questions, guys, okay, about what we discussed, okay, please feel free to shoot. So one thing, okay, I wanted to point out to you is that if you are also looking for biases and where the market, okay, was, okay, at a certain point in the past, you can use this slider. Okay, and you can, okay, look at where the market is building up open interest at any point in time. So these are represented, okay, by the letters A, B, C, and E. These are nothing, okay, but TPO ones for us, and you can slide this anytime left or right to find out where the market was trading at a particular time, what was the price, what was the open interest, etc. You can choose it, and then, okay, again, okay, form a conviction based on the information which is there. Want to reset? Just press reset and it will come back, okay, to the current time. Yes, you can have line charts as well. I showed it to you. So this is a line chart of the 24,300. So in this case, okay, this was completely, okay, with writers, because like I mentioned, it was below VWAP. But if this goes up above this POC, okay, the last, okay, developed zone of that POC, and it goes up above VWAP, that is the time, okay, you can look for long gamma trades, okay, in this particular instrument. Right, so to get into a line chart of an option, all you have to do is go to the index table and choose, okay, the column, okay, called strike, and you would be getting it over there. Any more questions, guys, on what we discussed? So just to sum up, what we are looking for is a way, okay, to understand the data. What we are looking for is a way, okay, to understand data and the information, okay, which the market is trying to give us. Why the options table? The market is always, okay, feeding us a lot more information, and sometimes, okay, the information, okay, coming from the market is overwhelming, is big. It is there, okay, for us to there. But the whole purpose of us as traders is to learn how to monetize this information. And if you are in a position, okay, to monetize, okay, the information which the market is giving you, okay, data is a new oil. Data is, okay, what is driving everything in the market today. And I have been a trader, okay, who's always believed, okay, that we have to exploit the power in data. And if you keep ignoring data, if you keep ignoring information, and if you're relying, okay, on old, outdated information, then you're putting yourself up for a life of struggle in the markets. The markets, okay, tend to keep changing all the times. Just like how I love my cricket, and I use this example a lot, okay, when I'm talking to my friends also. The cricket, okay, which was played, okay, by the likes of Kapil Dev and Ravi Shastri and Sunil Gavaskar back in the 80s is very, very different, okay, from the cricket, okay, which is played today. In fact, okay, Sunil Gavaskar, when he was playing, he was not even going, okay, to the crease, okay, with a proper helmet. Now, I remember images of him, okay, wearing that white kind of a protection, and that is all he had. He never wore a helmet in his life. And fast forward to 2024, you will not find a single cricketer facing a fast bowler without a helmet. It's mandated in the rules also that you have to wear a helmet compulsorily today. And not just that, okay, they have arm guard protection and all kinds of guards, etc., etc. The game has changed. Now, why am I saying that? Because a lot of traders, okay, when they come to the markets, they are focused, okay, on a lot of trading strategies, okay, which were once, okay, very useful, but back in about 90s and 2000s and 2010, the last decade, the kind of change, okay, which has happened in the market has been astronomical, big, huge impact. It has propelled NSE to be the #1 derivatives exchange in the world in terms of contracts traded. And it's not just retail traders, it's a lot of institutions, okay, from overseas who have come in, okay, and who are trading in these markets today, right? So it's up to you, okay. You can ignore all that is happening around you, okay, or you can make life better for yourself. And the way, okay, you can make life better for yourself is to arm yourself with information, and not just arm yourself with information, learn how to strategize with that information, learn how to monetize with that information. Now for that there is work involved, and you will have to put that work. You cannot come back, okay, to the markets again and again as that same person, okay, who traded yesterday, right? Even if you made a loss, the fact, okay, that you did not take a lesson out of that loss does not change you as a trader. So even if a loss, okay, comes in, it gives you a lesson, it teaches you something, it tells you, okay, what you should not do. And if you're not taking those lessons, okay, you're not progressing, okay, and becoming a better trader, right? If you're not taking help, okay, from your community, from the people, okay, you trade with, or if you're surrounded yourself, okay, in a community, okay, which pulls you down all the time, you're not growing, you're making life difficult for you as a trader also, right? Now, why am I saying all this? Because I've seen a lot of traders change when they have been given new information, and I've seen them change, okay, when they have changed their tools, and I've seen them change, okay, when they have changed the way, okay, they trade and the strategies, okay, they have traded. A lot of traders have come to me and they have told me, okay, no, this is not working for me, and I've told them, try it this way, and they have gone to trade that way and they have got those results, okay, for themselves. It's just a new way of looking at everything, and there's always a new way of looking at things, provided, okay, you go and you search for it, right? So I leave you with this. We discussed, okay, a lot, okay, about what the options table was. I nudged you to go beyond looking at price and to focus on VWAP and VPOC. I also nudged you to find out on points from where, okay, the VPOC is in a line chart, in a market profile chart. I asked you, okay, to look at the information from open interest, why market profile, and if possible, okay, if you can go to an order flow chart to find out, okay, where the imbalances are. All of that collectively, okay, together can put you on a very sound footing when it comes, okay, to picking up biases from the market. So I hope, okay, this session was useful to all of you. If you have any questions, okay, please feel free to share. Please feel free to ask. I am, okay, always on Twitter. Okay, you can, okay, always, okay, DM me, or you can, okay, message me over there. Our support numbers are 9284331270 on WhatsApp, or you can also message us on support@vtrender.com. Right? Thank you all for coming in. There's going to be a recording of this, okay, kept for you on YouTube, just in case, okay, you want to go through it again. But I'll join you for our next session, which is going to be the coming Monday, where we're going to be looking at the weekly outlook again, right? So that's it for me for now. Thank you all for coming in, and we'll see you, okay, soon. Thank you.